right. Morning. Give me a few minutes to double check all the settings, make sure everything's going. Let me make sure all the sound is going through to all platforms. We'll get started. And my loud ass cat. Man, my camera's doing weird things today. I hope audio doesn't end up weird later on. Hopefully be getting a dedicated mic in soon. Those issues. Page.
Ladies and gentlemen, thank you for standing by, and welcome to the fourth quarter and full year 2020 Coherus Bioscience conference call. At this time, all participants' lines are in a listen-only mode. Later, we will conduct a question-and-answer session, and instructions will follow at the time. If anyone should require assistance during the conference, please press star and 0 on your touch-tone telephone. I would now like to turn the conference over to your host today, Mr. David Stilwell. Sir, please go ahead.
Thank you. Good afternoon, everyone, and thank you for joining us. We issued a press release earlier announcing our 2020 fiscal year and fourth quarter results, and the release can be found on the Coherus Biosciences website. Today's call includes forward-looking statements regarding Coherus' current expectations. These statements include, but are not limited to, our ability to advance our biosimilar and immuno-oncology product candidates through development and registration, our commercialization of UDENYCA and other potential products in the future, our ability to meet our R&D and SG&A expense guidance for 2021, as well as our uses of capital, all of which involve certain assumptions, risks, and uncertainties that are beyond our control and could cause actual results to differ from these statements. These statements are not guarantees of future performance and are subject to certain risks and uncertainties that are discussed in documents that we file with the Securities and Exchange Commission, specifically in our quarterly report on Form 10-Q for the quarter ended September 30th, 2020. The forward-looking statements stated today are made as of this date, and we undertake no duty to update such information except as required under applicable law. Joining me for today's call are Denny Lanfear, Chief Executive Officer, Jean Viret, Chief Financial Officer, Vince Anicetti, Chief Operating Officer, and Chris Thompson, Executive Vice President of Sales. I'll now turn the call over to Denny.
Thank you, McDavid, and welcome everyone to our call. This afternoon, I will review recent business highlights and pipeline progress. Chris will provide his perspective on pegfilgrastim market dynamics and fourth quarter UDENYCA performance. And John McDavid will discuss fourth quarter and full year 2020 financial results, as well as expense guidance for 2021. We'll then open the call for questions. Certainly, COVID-19 made 2020 a difficult year for UDENYCA, impacting our ability to grow market share as planned in the face of new competitive entrants. While there will be some continued price share competitive pressure on UDENYCA sales in early 2021, we expect that as COVID recedes, we will resume market share growth, largely coming at the expense of Neulasta Onpro. We see 2021 as a year of fundamental transition and an inflection point for Coherus. We are extending our mission and expanding our late-stage pipeline to include immuno-oncology with our recently announced collaboration with Junshi Biosciences for U.S. and Canada rights to their PD-1 inhibitor, toripalimab. The transaction is projected to close later this quarter. Toripalimab is being evaluated for a wide range of tumor types in 15 ongoing or completed registrational trials. We eagerly anticipate the first BLA to be filed this year for nasopharyngeal carcinoma, which has been granted breakthrough therapy designation by the FDA. Earlier this month, toripalimab was approved in China for this indication, and regulatory authorities there have also begun a review of toripalimab for first-line treatment of nasopharyngeal carcinoma. Over the next few years, we expect the extensive clinical development program to support multiple BLA submissions for rare and highly prevalent tumor types, including lung cancer.
Okay.
As the label expands,
had a whole bunch of
we project significant revenue
stuff to get in place. Might get them started a little bit later than normal.
Evaluating toripalimab in combination with other immuno-oncology agents will provide longer-term growth opportunities. As part of the collaboration, we will obtain options on anti-TIGIT antibody and an engineered IL-2 cytokine, as well as certain negotiation rights to 2 other immuno-oncology molecules. Once the transaction
First things first, wanted to sort of actually look at our watch list. I have 3 sort of combined graphs that I look at sort of
and mutual success with these programs.
Just
Now, later this
take
year,
into account all of our evaluations that we've done so far, all the information that can be gleaned from them, and essentially trying to determine which are the best buys based off of the valuations I've made. So if you don't really agree with the valuations I've made in the past live streams, well, then these graphs don't really mean much to you. But I mean, this is the type of tool that I use for trying to determine what types of things are perhaps the best buys out of the universe of my knowledge. This is just one of those graphs. Like I said, it's adjusted PE, which is the PE that we use after adjusting earnings for R&D expenses. So it's usually lower than a lot of other PEs, although for some companies it's actually higher. But that's on the vertical axis against the projected profit margin, which is the profit margin that my valuation projects for each of these companies 5 years out. So it's basically the current valuation against the expected profit margins, which a lot of people put PEs against growth, and I think the future profit margin sort of takes growth into account, but also takes profitability into account. I think it's a better measure. But like I said, it also is projected profit margin, so it's not a profit margin that the companies currently have by any measure. But it can maybe help take into account high PEs. If they're really high up on the y-axis, but they're really far out, then that sort of helps to explain their valuation more. Which, granted, there's not that many companies out here. Area. Only one here is a real estate company. So real estate often has high margins because of the different tax treatment, as well as they often have high PEs because of depreciation. So it's a little bit of an outlier in that category, and LTC is also real estate, so that helps explain their high margins, although they don't trade very high in the level. But obviously the medians and the average come out to be in the middle there pretty evenly. I do have the best fit line in place here, which I do like to use. You can kind of say that anything below the line is undervalued to a degree, and then obviously you want it to be as far out this direction as possible for that. So basically anything over here is a good deal. FP is, I guess, borderline in that sense. LTC's supposedly a good deal on this basis. But I mean, as anybody, if you watch my video on that, I have my reasons and my concerns related to them. BIB is a good deal, QCOM's relatively good deal, eBay is relatively good deal, even Intel's a relatively good deal. Although anything over here is also a good deal, it just doesn't have as high a margin, so perhaps there's reasons to not want them, but they're still good deals. And I mean, plenty of positions I have. But that's just the earnings regression combined graph. We also have one for sales. So we do have one for the enterprise value to sales, which is on the y-axis against projected excess returns.
Thank you, Danny.
Excess returns being the returns on invested capital, which is the capital efficiency profitability measure that I use in my valuations. But it's also the projected one, and then minus the cost of capital. So returns on invested capital minus cost of capital is excess returns, and we're doing that projected 5 years out for both of those metrics, and then putting that against EV sales. I actually think this is an even better graph because EV to sales takes into account the debt levels of the company, and the projected excess returns takes into account their total profitability across all of their capital use. And not only that, but it also risk adjusts those returns back by the cost of capital. It doesn't take into account the debt to equity levels, so you would want to make sure that you don't have a super high debt company necessarily. Or if it is high debt, perhaps you want to make sure that it's managed well, because it's EV to sales, so it doesn't really say how much of this actually ends up in the equity hands. This is just the best graph to show, I guess you could say, how well the company's being run, because this is a firm level graph rather than an equity level graph, because we're looking at EV to sales, and we're not adjusting for the debt to equity level or the net income margin. So either way, again, best fits line, anything below the line is a pretty good buy. And then also this one is much more solidly further to the right is better, because this isn't profit margin, this is excess returns. So low excess returns and even negative excess returns are not super good unless it's maybe like a commodity cyclical company. You'll notice that Barrick and Royal Scheller here. That's the part of the reason why is because they still have lots of negative returns from low cyclicality parts of their function. Perhaps the same with Pembina as well. But in this case, you really do want to be further over here, in which case the best buy is still BIB, AbbVie, Altria is pretty good buy, eBay, Turtle Beach, Amazon appears to be a pretty good buy, and then HP also a good buy. And then on the third one, we have excess returns, which is now up here on the x-axis or the y-axis rather than the x-axis like the last one, against expected CHRS, which is the 5-year expected return that I have of that. So this is their firm level risk-adjusted return against a non-risk-adjusted total return expectation. So this is an equity return against a firm risk-adjusted return. So you can sort of see how well their firm returns line up with the equity returns. In this case, the best fit line doesn't give us much information about like where to be above or below. It doesn't really make a sense in that way. In fact, the inverse of the best fit line would be better. Place it along the median and the average, and then just make it completely perpendicular, and that would actually be a better line, and you would want to be further out to the right this way. Because in this case, you really want to be high on both, actually. I think that's HPQ. I'm not sure why that dot's not coming up. That's HPE. BIB is pretty high. Turtle Beach is pretty high. NF, EBA. AbbVie, Kroger, Amazon, Royal Shell, Gold. Although those have negative excess returns, but they have high return expectations. Which again, see, that's part of what I was saying about the cyclicality. And then Intel, and then a few others that are pretty good, but above that line, but get a little bit closer. So that's sort of the way to read these three graphs. And together, those are sort of how I say how you can locate the best buy. So in this graph, the best buys are theoretically over here. This graph, the best buys are theoretically over here. And this graph, the best buys are basically anything here. This one being the most important, this one being the second most important, and this one being the least important. And then, well, I have many other ones as well for the different sections, because we have different parts of these sectioned off into the companies that we've looked at, as well as the companies in my portfolio that we haven't looked at, because I mean, some of these companies are in my portfolio, but I've separated them out based off of whether we've looked at them or not. But in these graphs, it's actually all combined together. That way we have the most complete statistical data. So, that's that. Just wanted to explain how those graphs work a little bit better, so that as we fill them up a little bit more, as we do more evaluations, we're going to put more of those in.
With Bioscience, which is expected to close in the first quarter. We project $45 million to $50 million of stock compensation expense per year. The increase that we project in our operating expenses is primarily attributable to activities to advance our late-stage biosimilar portfolio, including manufacturing-related activities in preparation for the potential launch of CHRS 1420, if approved, and development activities for IBI 305. For Udenica, we are investing in marketing activities and in the development of additional presentations of the product. Before I close, on the IR front, I'll note that we're scheduled to present.
I talked through a lot of his opening little statement thing, but
and at the Barclays conference on March 9th at 1
I don't really care for it. Honestly, when it comes to earnings calls, I care much more about the analyst call-in questions.
you can see, we are successfully positioning Coherus for sustained future revenue growth. On the biosimilar side of the business, over the course of 2021, our progress towards growing and diversifying our product portfolio will become increasingly visible. In the next 2 years, we have the potential for approvals for biosimilars of Humira and Avastin. We believe that this product portfolio will deliver significant revenue growth and strong cash flow for continued investment in immuno-oncology. For immuno-oncology, we expect the first toripalimab BLA filing this year for nasopharyngeal carcinoma with potential approval in 2022. 15 pivotal clinical trials are underway. Additional BLAs will follow over the next 3 years for both rare and highly prevalent cancers, including non-small cell lung cancer. Several interactions with the FDA are planned for the remainder of this year as we finalize the registration strategy for these additional indications. We believe PD-1s will be the foundation for immuno-oncology therapy for the foreseeable future, increasingly used in combination with novel agents that synergistically enhance their activity. We are excited by the option programs we have with Junshi Biosciences for their TIGIT-targeted antibody and their engineered IL-2 cytokine in combination with toripalimab. We also anticipate that other companies or academic institutions may well bring forward novel compounds to evaluate in combination with toripalimab. Strategically, we see such business development activities as another way to extend our immuno-oncology franchise and to drive additional toripalimab share and to advance our new treatments for the benefit of patients. After launch, we expect toripalimab to grow consistently into an expanding market year after year as additional indications are added to the label. And finally, before we turn to your questions, I want to thank my good friend Jean Viret for his years at Coherus. Jean joined before our IPO and brought his considerable capabilities to bear as we commercialized our first product. Under JV's leadership, Coherus developed a very strong finance and accounting function, and for that, we are especially grateful. John leaves us in very good favor, and we wish him the very best. Thank you, JV. I'll now ask the operator to open the call to your questions.
Get it on.
Thank you. Ladies and gentlemen, if you have a question at this time, please press the star and then the number 1 key on your touch-tone telephone. If your question has been answered or you wish to remove yourself from the queue, please press the hash key. We will limit 2 questions per each participant.
It must be a sweet gig managing those calls.
Respectively. First question comes from the line of Chris Schott from
Wonder how it pays.
Your line is now open. You may ask a question.
Great. Thanks so much for the question. I guess the first one on UDENYCA sales. Can you just provide maybe a bit more context around 1Q? I'm just trying to get a sense of, it sounds like it's kind of dipping in 1Q and then kind of recovering from there. So just maybe a little bit more color of how much of a step down should we think about relative to 4Q as we think about some of the inventory dynamics, et cetera, that you mentioned? And I just have one follow-up from there.
Thanks, Chris. Mr. Thompson, do you want to take that question about the dynamics of Q1? Make a few comments.
Yeah, sure. Thanks, Denny, and thanks for your question, Chris. I think, in 1Q, we're going to really see a sort of a paradigm shift here as COVID recedes and, the population gets vaccinated. I think what we're going to see is a dynamic where, we have this huge opportunity with Neulasta Onpro. They've got a stable share in the mid-50% range, which represents a huge reservoir of opportunity for us. And I think that, we'll start to see that evolving, especially as we go from Q1 to Q2. But, given some of the surges that we saw in Q1 with COVID, I think that will definitely have somewhat of an impact on Q1 for us. Keep in mind that, when we think about Onpro, it's just a big thing relative to what's actually happening in the marketplace now. We're sort of relegated to really trading share with each other, the biosimilars. As it relates to inventory, we feel confident that inventory is going to return to normal state. It already has, so we're in good shape there. I don't know if that answered your question.
Yeah. Thanks, Mr. Thompson.
It's actually one of the reasons that I'm pretty interested in Coherus in general as part of their biosimilar business, and as well as their Imbrovica business as well, because Imbrovica is partially R&D licensed through one of my other holdings, as well as one of the biosimilars that they're attempting to pursue in the near future is for Humira, which is also for my other holdings of AbbVie. I'm actually rather bullish on AbbVie, but the one real hangup on AbbVie is just how much their Humira sales will be eaten up by biosimilars, and whether or not they can recoup a decent amount of it through their own biosimilar, as well as that they've made acquisitions to diverse their income stream from that. So I've been basically been keeping an eye on Coherus as basically an opportunity that if it dips to the right level and you can get the right price for it, it would become the perfect hedge against AbbVie, where both of them have their own alternative possibilities where they're not in competition with each other, but on the off chance where AbbVie struggles more than I expect them to, Coherus would probably pick up the slack in that move. So it would be a complementary pair trade, so to speak. But AbbVie, I'm not so as concerned about the like I said, even if it underperforms my expectations of being able to manage those issues, it has other alternatives that means that it won't likely decline super far anyway, and they have a high dividend. So basically, between the two, that would really boost the overall returns between each. I think, basically covering a little bit more of that alternative basis where Humira sales do decline much heavier on AbbVie because then I'd own one of the places where they'd be picked up. So it's like have a relatively smaller share of Coherus, maybe like half as much as Coherus as I have AbbVie, whatever that happens to be. But I kind of want to buy more AbbVie, so that just is what that is. I haven't done so, but I've been kind of keeping in mind, according to the earnings reg, they're a little expensive, but they always trade a little high on the PE level. According to the firm level, they are a little undervalued, though they're pretty good on the projected excess returns. And then on this level, they are relatively one of the better ones in almost into the top quadrant of categories. If you're dividing along this line by quadrants, or this is the average, and then by that half, it's like they're just below the highest quadrant there. But yeah, so just
I would just make one further
kind of strategic point why I'm looking at Coherus.
Last year, between COVID waves, we saw Onpro recede significantly between those waves, and so we're quite confident then as the vaccinations progress and people get back to normal, that we will see this happen once again, perhaps with greater rapidity. We think that the incentives are already priced into the market for that, and we believe that we are very well positioned to capitalize on that as soon as COVID fades.
Great. And just my follow-up question was, when we think about the PD-1, your initial indication is a fairly small one. You've got some obviously much larger ones to follow. So I guess how should we be thinking about that ramp of that first indication, and how indicative or not will this initial ramp be for future larger indications? I'm just trying to get a sense of, basically, is this first indication going to tell us much about the potential for kind of a new PD-1 in the market, or do we really need to see the bigger indications before we get a better sense of how this is going to play in the marketplace versus some of the existing kind of entrenched competition?
Great question, Chris. I believe that we are going to do very well with our execution around the first indication. One of the things that Coherus is just excellent at, as you've seen in the biosimilar business, is a very holistic execution around the Medicare Part B space, the buy and bill space. We will be the team that has the labeled indication for this orphan. It will be small, but I think that we'll do very, very well with it. More importantly, we'll start to be able to socialize our brand into the market. We'll be talking to the payers, the providers, the physicians, the nurses. I think it's a great entry point for us as we go forward. So I think we'll ramp up very quickly there with the PD-1. But of course, what's going to be very exciting is we start to add some additional indications. We think that there's going to be probably at least one additional indication filed per year. We've prioritized the largest ones, such as lung. So I just say stay tuned to that, but we're fairly excited that we're going to do very well in this market.
Thank you. Next question comes on the line of Mohit Bansal from Citi. Your line is now open. You may ask your question.
Great. Thanks for taking my question. And before I begin, thank you very much, John, for all your help during all these years. Thank you very much for that. So maybe starting with UDENYCA. So if you look in last few quarters,
yeah, I don't think they actually give
UDENYCA has been
geographic information. They just kind of presume the 100% US,
while
right?
other biosimilars have been slowly chipping away, but not.
Just trying to make sure of that.
So you mentioned it is probably due to.
That's what I have in my old spreadsheet over here, but I didn't really want to
how do you think about
erase the entire grouping.
After COVID, what gives you confidence that you can probably take more share from Onpro? And having an on-body injector, do you think it is necessary to take more share from Onpro at this point?
Yeah, I'll take that one first, and I'll let Mr. Thompson backfill. I think that if you take a look at 2020 Mohit, there was the ebb and flow of COVID across, right? There was the first wave in Q2. I think we showed some very good numbers there in the face of Q2. We began to come back, and COVID came back.
Lose power.
As we've spoken before, COVID put the market in a bit of, I'd say, stasis. Very hard for new entrants to make substantial
so I guess
gains.
I don't need the country premium page.
Competitors. Easier for the entrenched competitor Amgen to leverage the inherent market advantage of the Onpro system in that market. So, all in, we consider that we did a pretty good job maintaining share through 2020 in the face of that. We didn't have to endure quite the same price cuts that the innovator did to maintain share. Now, going forward in 2021, it sort of depends on how fast things go with the vaccine
operating beta
and so on. Most of the stuff we've seen is that things are looking better, certainly now through Q1. I would expect that to continue in Q2. So, perhaps an uptick
industrial
in
average
Q2
sales
and
to capital ratio 0.48.
We expect quarters to grow successively as we go on through 2021. But we think the market, while I wouldn't say it's going to come to us, we think we'll do very well in this market in 2021 in terms of moving forward. I think we're poised and ready.
Got it.
Chris, do you have a comment?
Yeah, I was going to say, I agree with everything that Denny says. But, if you think about it, we've already ran the experiment. Q1, Q2 of last year, you could see that we were making significant inroads on Onpro share because it really is a better value proposition for the providers.
As an industry.
We anticipate as the vaccination program expands, as the COVID spikes recede, that we're going to pick up where we left off and make significant inroads in there. We are the biosimilar market leader at 21% share, and we're pretty excited about the fact that we're going to expand upon that market leadership position. I'll just give you an anecdote as well. There's several large institutions in the Midwest, and I'm out there talking to customers all the time. And these institutions had made virtually a total conversion to UDENYCA early last year. And obviously with the spikes in COVID and all the problems we had with COVID and the convenience of Onpro, they were forced to actually go to more Onpro. We lost share there. And I'm happy to report right now, and speaking with these customers, that they've already started to move back to UDENYCA in a pretty large way. To me, that's sort of the canary in the coal mine. That's indicative of what's going to happen with accounts across the United States because it's such a compelling value proposition for our customers. Onpro is going to go.
It's so interesting that they separate out the
an expensive necessity
payment schedule for all of their debt obligations.
To really
very
an expensive convenience. And most folks now, given the economic states they're in, whether it's a clinic or a hospital, they've got to be looking at the economics, and UDENYCA provides the best economics for these.
Sorry, I have a total baby of a cat that I have to pacify.
Thank you. Next question comes from the line of Salim Syed from Mizuho. Your line is now open. You may ask a question.
Great. Good afternoon, guys. And I'd like to add my thanks to Jean and congrats to McDavid for stepping into the role. couple from me, Denny, if I can, and then just one maybe housekeeping if that's possible. Denny, just one high-level question for the biosimilars industry.
Here we go.
I'm curious, one of the things that I've been sort of thinking about on this business, what was the point, when you looked at, 2 years of biosimilar launch with UDENYCA, what was the point where you decided that, going after a novel strategy was the more, the thing that you wanted to break away pretty hard from being a pure play biosimilars, which some investors thought was a plus for the story? Well, I'm just curious what that point was, to break away hard and say novel is kind of like the way to go. That's question one. And then two, just on the CFO transition, just curious, McDavid, if there's anything that we should expect differently as you transition into the role. And then if I can sneak in just a quick housekeeping one that some folks have asked on the EYLEA.
This will be three for you, Salim.
Okay, I can stop at two. That's no worries.
Okay, all right. So let me handle the first one. So, I don't believe there was a breaking point with respect to strategy. The company was founded with the mission of delivering, savings to the healthcare system and greater access to the patients. That was really the key issue. We always felt very, very strongly about that. All my co-founders that came out of Amgen and Genentech, and had worked in those shops, they all felt that this was the moral high ground and really the right thing to do. And I think that as early as 2016, we began to look at PD-1s and the evolving landscape and so on, and how they looked. Our view is that, there is substantial value to be delivered to the healthcare system. There's good to be done by delivering on a PD-1 because they're becoming ubiquitous across immuno-oncology. So we see very, very broad utilization for our product because we can deliver a value proposition as we have with UDENYCA, right? We have a very high quality product, very broad label. We've got a great partner, has invested heavily. I think that really the market is going to welcome us with open arms. We're going to start small, we're going to expand, but you'll see continued growth. But I don't really think that there was sort of a religious dedication to biosimilars. Biosimilars are a way to deliver value, and that's what we saw. And so if we can leverage the capabilities across the organization, protein science, clin reg expertise, and primarily our commercial capabilities, which are quite strong, as you know, we think that's a way
to when companies put things in thousands.
Shareholder value. And it
Come on,
really wasn't any more.
Put it in millions like a big boy.
I'll let McDavid speak for himself as far as how he's going to follow in the large footsteps left by JV. McDavid?
Yeah, as Denny said, we are very grateful that Jean created such a strong accounting and finance function at Coherus, and I am very much looking forward to working closely with all of those team members and with our external partners such as EY and others. So I'm very pleased with the state of that organization and really looking forward to being a part of that team. I'm going to be spending a lot of time also with investors and analysts as our story evolves, and it's evolving very quickly in 2021, and connecting investors to the promise of the story as the potential approvals come along with biosimilars, Lucentis, Avastin, Humira, and also as potential approvals come through the toripalimab program, which will begin to stack up, we believe, very quickly. And so there's a great deal of value that we believe we're creating with this growing and diversified portfolio of product candidates that's moving through. And I want to spend a lot of time with investors and analysts and make sure that they understand that value. So that's a big part of my job.
Yeah, Salim, the other point that I would give you is since the announcement that we were entering the immuno-oncology and PD-1 space, we've had very positive, supportive outreach from our customer base in oncology. I think they're highly
weighted average book interest rate of 5.5% or so.
Talk to us, and we've had some
430 million, not very much.
So I think that
4
the
years
environment
though.
is really, really ready for this sort of an approach. It's worked very well in
my dad.
And I think we're going to do quite well in the PD-1 space, frankly. I think we're the right solution at the right time.
Okay.
Next question comes from the line of Elijah Prasad from Barclays. Your line is now open. You may ask a question.
Hi, good afternoon. Thanks for taking the questions. Firstly, again, Jean-Marie, all the best. And it was great speaking to you over the past couple of years. And coming to... Coming to the questions, one line in your statement caught my interest where you said that your R&D spending will increase on additional presentations of UDENYCA. So just want to understand, I would imagine that this is the on-body device, and I want to compare this with what you had said earlier recently that you would not be investing further dollars in biosimilars. So I take that there's a one-off exception. Second, I would like to understand your degree of confidence and the gating factors for each of the 3 BLAs that you plan to submit this year, Lucentis, Avastin, and toripalimab. I think probably will need some assurance on that front. I'll stop here with these 2. Thanks.
Great. Well, thank you for that, Balaji. So we have previously reflected to you on calls that we're pleased with our progress in on-body, and I think you can safely assume that means that we have made investments, and those are going to show up in the financial statements.
Pretty small amount of RSUs. That's good.
Spend a little money to make progress there. I don't think
that neutral.
That's quite the same as, for example, committing significant funds to phase 3 for an EYLEA product or things like that, right? So I don't see any incongruity with respect to line extensions or additional presentations of UDENYCA at all with that. I think that's something that we've pursued and it's consistent that that product's approved and so on. Now, with respect to the confidence in the BLAs, I think first of all I'll talk about the toripalimab BLA, and then I'll let Vince Anicetti, our Chief Operating Officer, say a few more comments with these others. With respect to the toripalimab BLA, I think that we're in very good shape. Our partner Junshi has had several conversations going back over a year with FDA on that indication, nasopharyngeal indication. They've got breakthrough status, it's an orphan and so on. So I think they've had a lot of conversations. They got very solid data, of course. They've been approved in China. The follow-on first line has been submitted in China. So I think that's buttoned up pretty well. With respect to the BLA, I think the issue there now will be in order to get approval, they'll have to get an inspection of facilities, and that facility, that product, of course, is made in China. So the FDA is going to have to find a way to get that facility inspection done in a timely fashion. It's an unmet need and so on. So we're hopeful that they'll sort that out. And of course, the FDA has just really been focused on the J&J vaccine, a number of things. So we have a lot of empathy for the FDA's work. I can't believe how hard they're working and how well they're doing. So, but overall, I think they'll get to this and sort it out. Now, the other BLAs are coming. Of course, the 1420 BLA for Humira has been filed and accepted. I'll let Vince talk about that.
There it is.
The Lucentis BLA is upcoming, and BioEq is going to file that. I'll let Vince
exactly what I was talking about.
Comment on those two.
They can get the Humira BLA in, and then they become a pretty sweet
1420, as we announced,
pair, essentially, against the possible downsides involved in
the BLA in order and all of the necessary information there. We also have had a number of meetings over the last year with the FDA reviewing our development program, both on the clinical and the manufacturing analytical side. We received a lot of guidance from the FDA. They gave us a very good roadmap. So we are receiving questions from them now, and I would characterize them as routine, and we expect the review to go well, I would say, and hopefully get a positive decision from the FDA in December on our action date. In regard to the BioEq Lucentis biosimilar, in a similar fashion, BioEq has been working with the FDA very closely to resolve all of the prior issues with their prior submission prior to their decision to withdraw. And in a very recent meeting in Q1, reviewing all of the work that was done to remediate those deficiencies, FDA felt that the work was done in an acceptable way and agreed that BioEq could go forward and submit that BLA for review, which we see as a very positive sign. So that will go in mid-year, and we expect that review to go well too.
Does that help on those questions with the BLAs, Balaji?
The question has been resolved. And next question, we have Jason Gerberry from Bank of America. Your line is now open. You may ask a question.
Hey guys, thank you for taking my questions, and also want to extend my gratitude to JV for all the help over the years, and best of luck in future endeavors. So my question.
So here's a perfect example of what I mean by adjusting for R&D does not always improve your multiple. They traded a multiple of 8 according to the main market. After adjusting for R&D, it's actually 10. The reason why is because they have more R&D in the past than they do in the most recent years. See, so it's like R&D will help your earnings as long as you keep growing it in line with your revenues. But if you slow down your R&D growth, then it starts to actually hurt your multiple for a little bit, and then it'll work itself out. But
categories on a net price basis, and I noticed on your last call you mentioned that cancer might be an underappreciated category for price sensitivity. So just kind of curious if you can get your overarching thoughts on that topic. Thanks.
Well, thanks a lot. Thanks a lot for the question. I think that the overarching short answer is that I think that we have demonstrated in the biosimilar business that we are very fierce and competent competitors who don't resort to the price lever to drive share. Right? We understand our customers' needs. We understand the value proposition. We spent 2 years before we entered and launched into that market just understanding what the customers needed and fashioning the value proposition, establishing the relationships, and then we executed on it. I think you're going to see the very same thing here. You're going to see us go into this market and really understand what the needs of all the constituencies are in Medicare Part B and deliver on those in a very holistic fashion. And I think that bodes well for us. I'm not sure what the size impact is, these other places, and how much they need and so on. But I think that it's a market that is exactly matched to our commercial capabilities. And further, I think that we are sized accordingly to deliver on it. We're certainly going to buff up our MSL teams and our reimbursement teams and things like that. But structurally, our organization is very well put together to scale for the challenge. So I think that we're fairly optimistic, and I think that we'll be fine. I'll give you a little more detail on that once we get a little further into lung. We actually get the filing in.
No real selective non-cash adjustments.
With our market research on other calls, we'll be very open with you on how we want to talk about it.
They did build up their working capital.
And we're not afraid. We're obviously not afraid of competition. We're absolute fierce, competent competitors.
Yeah, if anything, they're the ones that are making other people afraid.
Pull the files in before we get a better sense of what the customers really need.
They've been living on the edge for years. I mean, look at them. They literally had zero revenues a few years ago.
I don't know if there's
revenues are all over the place.
I wouldn't say that, but I would say there may be a
feeling this executive team lives fearlessly.
That these folks want. I will only take you back to the comments that Chris Thompson and I made, is that when we announced that we had done this transaction and we're moving PD-1 space, we had a outpouring of support from various quarters of the oncology, the clinical oncology teams and others, large organizations who welcomed us, to this particular market segment. So I think these folks are very happy that we're coming.
Yeah, Denny, it's Chris. If I could add, prior to signing the deal with Junshi, we were doing a lot of outreach, trying to understand what providers, what physicians were looking for as it relates to PD-1. And in doing so, they were very excited that we were entering this market.
Upfront milestone-based license fee payment as part of their capital expenditures.
Buy from whom they trust and who they know.
When it comes to pharmaceutical and biotech, you kind of have to think a little bit outside of the box as far as their capital goes. Because it's not really about their factories so much as the intangible assets that pharmaceutical companies and biosimilars and biotech companies. So this is a license-based business. We're going to call their payments for license fee milestones. It's part of their capital expenditures. I mean, they include it in investing activities themselves.
You can look at CFS across these various products, and you see very, very similar readouts, very similar mechanisms.
Now add up their
so I think this plays well for us.
That stuff.
We have the next question comes from the line of Greg Gilbert from
plus proceeds from common stock issuance for exercise of options.
Great, thanks. Two, I'll ask them up front. My first question is about Humira. I'm curious how transferable and applicable you think the Udenica example is to Humira, given the different sort of channels and incentives in the system. Maybe talk about difference in out-of-pocket at the patient level. I'm not so sure exactly what saving the system money means in one case versus the other.
They issued a lot of debt because they put some of those convertible bonds into play just last year.
On that, but curious about the out-of-pocket at the patient level between those two. And then, Denny, I was intrigued by your comments on the last call about the potential for biosimilars to Keytruda not to show up in 2028, and that it may be harder than people think to get there. If you were wrong about that, and there are biosimilars to Keytruda in 2028,
subtract out the issuance from the exercise of options.
How you're working on your development strategy, and does your development strategy include co-formulations? As it appears,
no dividends paid.
A lot in that direction. Thank you.
Yeah, I think those are two great questions.
Yeah, so they're still weighing out the drag from the previous years with the lack of returns on invested capital. But if we just drop the average down,
show up in
your average
28 or 29, 4 or 5 years earlier than
they're starting to look very profitable, but they have to be able to maintain those revenues.
These PD-1s really need to be put together, as you point out, with combinations. This is the whole reason why we have the combinations available to us, the TIGITs, the engineered IL-2s, and others from our agreement with Junshi. And this is also why we stated on this call that we are open to combinations with other parties who come to us, either institutions or small companies and others, who want to do studies with us on combinations. So we think in the period from 2025 forward, it's going to be less
Let's do the balance sheet then.
Of monotherapy than it will be an issue of combinations. We think that we have a very, very good PD-1 here.
We're stocked up on cash. That's good.
Partnered with Junshi, and we think that we'll be very successful with that. So the base therapy is PD-1. Yeah, the biosimilars might show up, but I think that you have to have the combinations, and we've got a very robust pipeline of combos coming, and we welcome others. With respect to Humira and the co-pays and with the patients and so on, I don't want to say too much because we're really in position of working forward our strategy, and I don't want to show our strategic cards very much with Humira. But I would make a couple of points. The first point that I would make is that the presumption...
By the way, if you're watching and you're enjoying, please subscribe to the channel.
That patients that stay
like
on Humira,
all of the
streaming
things.
Go on to another therapy or whatever.
Please and thank you.
And then your market penetration
share if you would too.
Largely slowed by the need for fresh starts. We believe that large high control payers, by the time this comes around in 23, will embrace putting biosimilars high up on the formulary. They may have to step through that. We think that they will probably force switches in some case because there is just so much savings, and I think there's disintermediation available there, and I think that we're going to be prepared to serve very large parts of the market with supply guarantees, high quality product,
a state-of-the-art auto-injector, a non-sting formulation. We've looked at all this. I think that we are going to do very well in this space because of that. Again, I think the way to be successful in these businesses is to talk to your customers, to understand their needs. And so we are in that process now and understanding just what we have to do vis-a-vis the payers and, of course, the patients and the providers to do that. But I think that we put a stake in the ground here that we think we can take 10% market share at least. We're going to gear up for that, our manufacturing and so on. So we think this is going to be a great market, and there's significant savings to be delivered in the Humira side of the business.
Thank you. We have the next question comes from the line of Georgie Giordano from Cowen and Company. The line is now open. You may ask the question.
Hey guys, thank you so much for taking my question. So I guess as it relates to Lucentis and PD-1, if you think about the opportunity and your expertise, UDENYCA likely has somewhat different institutional engagement versus sales force and payer effort requirements. Could you characterize for us how the promotional effort and payer engagement might differ or be similar with Lucentis and the PD-1 asset? And then on the Junshi collaboration, we noticed that the majority of clinical trials they're running are China-based. Would it be possible to use the data from these trials for FDA approvals in the U.S., or would you have to run smaller U.S.-based trials?
That's where. Where am I missing the number here?
Okay.
There we go.
Let me unpack a little bit
of
that.
Current
let me do the last one first. So I think when you consider trials done anywhere in the world, the issue is less of histology-driven genetics, which is sometimes the case. But what you really want to watch out for, number one, is do you have the same standard of care, right?
Compensation.
Right? And then you have a relevant patient population.
We're going to include that.
So, Junshi has taken a very good look at this. We feel that lung, NPC, esophageal, urethral, triple-negative breast, all these indications transfer very, very well, and we think that those pivotal clinical trials will transfer to the United States. Now, Junshi and ourselves are going to spend our time through the rest of 2021 here talking to the FDA about what the registration strategies are on an indication-by-indication basis and see. But I would not assume that there's additional clinical work that needs to be done specifically with things like NPC is fine. But if you do run into some, histology-driven genetics, then you may have to do something else. But by and large, I think that these are high-quality trials that are transferable. Now, to your other question with respect to the Lucentis biosimilar, and then secondly the PD-1 biosimilar, I'll first take the PD-1 biosimilar and I'll part that out with respect to Medicare Part B, and then talk a little bit. I'll let Chris Thompson talk about the Lucentis.
So, always want to sort of check up with that. On the balance sheet side, we came up with $413 million for their debt, and then when we made the debt over here, we came up with $430 million, which is fine though, because the
payer strategy, all those things will line up very, very well with the PD-1.
Liabilities.
So we see that as a very synergistic product portfolio mix, and that's why we're
on the lease side
about that. And we've heard from all of these parties so far.
That might only be including the
excellent fit. The
finance leases in there, but the operating leases might be
Chris, do you want to talk a little
up here somewhere
about the Lucentis
That's fine.
Market
it's relatively close. That's what you want to make sure of. It doesn't have to be precise. Because this just balances out with this. It doesn't involve the calculation. The debt that actually gets involved in the evaluation is the one that we come up with.
Being that it's a Part B drug.
That's the part that matters.
And our capabilities around that are recognized by our customers as being outstanding, and understanding that market, understanding the importance of ASP, understanding their business models on how they generate revenue within their clinics. We think all of this expertise is transferable to Lucentis. As a matter of fact, 2 days ago, we're part of presenting to a focus group of retina specialists and talking with them and trying to understand their business models. They're very excited about Coherus entering with a biosimilar in the future. We did get some good points from them on things we want to consider in our value proposition with that specialty.
They brought their deficit down.
And we pride ourselves in being able to really shape great value for whatever specialty we enter. But if you think about the skills that are necessary to be successful here, we have those. We have that experience in Part B. And the same will relate to our payer team, who works with on the medical benefit side, on the commercial side, right? It's the same business as Udenica, and we have those relationships in place, and we believe that they're very anxious to have that type of competition in the marketplace.
Yeah. Hey, Chris, just one more thing. Can you comment on the applicability of Coherus Complete in our reimbursement efforts?
But did I screw up?
Yeah, I'm glad you asked that, Denny. That was one of the things that struck a chord the other night when we were talking with these 10 healthcare professionals, retinal specialists, is the fact that, we have Coherus Complete, which is our hub for patient services, which provides everything from copay assistance to indigent patient care, to benefit verification, to prior authorizations. When you put that whole package together, it works nicely.
That number is the same as that one.
Of a retinal specialist's office, and takes some of the burden away from them to have to manually do all this. We've actually streamlined most recently our benefits verifications and prior authorizations.
That's where I'm like super dyslexic sometimes.
So this really takes a lot of time, burden away from their office staff and helps them, be more efficient. These customers are always very excited about that. Workflow is important.
Okay, thank you.
Okay, next question comes from the line.
Whatever number I screwed up, I do not see it.
Now open, you may ask a question.
Hi, good afternoon, and just want to wish JV well and join everybody else in saying how great it's been working.
Sometimes their balance sheets are not actually perfect, so sometimes they have odd things that screw it up themselves.
In terms of some of the
But
characteristics of
I try to assume it's my fault.
I was just wondering if you were in position to provide any color in terms of the TIGIT as well as the IL-2, in terms of how those molecules might be, maybe differentiated is the wrong way, but if there are any unique characteristics that make you think they're particularly appealing.
Thanks for the question, Doug. I'm going to hedge a little bit on this because we have not yet cleared Hart-Scott-Rodino, and we'll probably have a little bit more to say about this as additional data is generated later in the year. But I think that there's precedence in the literature if you look at the TIGITs and their synergy, for example, in lung with PD-1s, or if you look at the engineered IL-2s and so forth. You can dig out some
$6,800 worth of something's missing, but I don't really know
point you to that, or if you want us to refer
what or where.
Some of those publications, I can have one of my team members take that on.
All these numbers appear to be right.
Point that to you. But I think there is a plethora of complementary combination products in development at Junshi, and I think particularly what's attractive about the transaction as structured is that our expenditures are limited to $25 million per product per year.
Might be about to just
so that gives us a fair amount of P&L predictability as we go forward, particularly over the next couple of years while we're watching the dollars. And I think that really sort of puts us in a position where we can participate in global development programs with these assets, and still, though, we have cost control, which, of course, is attractive to us and our investors. So I'll kind of have to stop there, but next call, I think we'll have a little more to say to you about that, and in the interim, we'll be happy to forward some scientific literature off to you.
Okay, that'd be really helpful. And then just as a follow-up in terms of the Lucentis opportunity, at what point, now that we're nearing, BLA submission, should we think about any sort of increase in SG&A or the commercial infrastructure ahead of that launch? And will it be necessarily, noticeable, or is this something that you can accomplish pretty efficiently, and so, should be, not too impactful, especially in the context of the hope that we can start to see UDENYCA growing again next year? Thank you.
Yeah, thanks for that one. I would say not too impactful. I think you used the right term.
Oh, that's the problem.
We have significant investments already in our information technology infrastructure.
That's right.
Dashboard system.
Because there was no revenues a couple of years ago.
A marketing manager, here and there to focus on things.
Margin it gets for 3 years ago is nothing, and I was using the 3-year average as the base
concentration of accounts, number of
to start
people,
from,
maybe it's
project
20,
from.
folks,
So
something along that order.
we'll switch it to the 2-year average.
We haven't really come down on how exactly.
Don't get too excited about that.
And I will say that if we get the filing in around here, mid-year or so, as we said, we'll give you a little more color on that. But in any case, we don't think there's going to be a substantial ramp up on the expense line for this. And as you heard from Chris Thompson, we've already started outreach to the community of ophthalmology, understanding what the value proposition needs to look like. And I think fashioning the value proposition is the most important thing right now. So we're focused there.
Last question comes from the line of Balaji Prasad from Barclays. Your line is now open to ask a question.
Thank you. Sorry. I just wanted to get back to you, Danny, when you're asking me if you had answered the questions. The third BLA that I mentioned was Avastin, and I wanted to get your sense of confidence on that. Incidentally, I found the responses on the other two very useful. Thank you.
Thanks for that. I think that we disclosed today that we're underway with the 3-way PK study. We got slowed down on that one a little bit last year with COVID. We did that deal, and then as soon as Chinese New Year was over, COVID hit, everything kind of ground to a halt. The FDA pivoted, and so that slowed things up. I think it's fair to say that things are running along fairly well at this time, making good progress on the trial. So we'll give you an update on the next call on that one when we have a little more clarity. But that's about where it is. But that was one of these things last year where we, it was COVID, just COVID impact on that one. But it's clipping along, fairly well now.
Thank you.
All right, thank you.
No further question at this time.
But it decline this year and then go back up next year and relatively balance on that.
Thank you, everybody, for joining us on the call today. Look forward to speaking to you again in the near future.
It's one net. They're expecting like maybe 2 to 3% over the next 2 years.
Ladies and gentlemen, that concludes today's conference call. Thank you all for participating. You may now disconnect.
Why do you even have this on your page when you don't? Dividend. A little weird. Maybe that's just me. So even getting like the total addressable market's expected to be, if biosimilars don't grow in the next 5 years, but the PD-1 market does grow, and so that'd be $58 billion of addressable market in 2025, or 56. We'll go with, and so 5% of that would be like $2 to $3 billion. So on the potential outside of things, you could potentially see that they go to 2-3 billion on like the real outside possibility, with well, I guess dropping to nothing is the potential. Not really, because the Humira patent's gonna go off, so they're gonna get biosimilar revenue no matter what, but they could still have the revenues perhaps cut in half. So definitely variance. I'm not sure whether or not I really want to put those expectations in. Hard to say. Do it there. They got basically similar projections as Zach's. I think that's perhaps reasonable. And I'll probably just leave the distribution alone. I'm pretty uncertain about that, or maybe I'll actually even flip it backwards slightly. Take it from the middle, flattening out distribution, reasonably comfortable. Grown a lot, but it's, as you can see, extremely chaotic, so it's really hard to say what the true trend is on that front. I think that's reasonable expectations. The expected COGR after distributing is not very crazy at all. Valued, we're not really there yet because we still have to think about this. But I mean, the same sort of thing here, where it's like we're using the 2-year average, which comes out to 14%, and that we're kind of keeping it somewhat in the middle there. Oh, well, the effective tax rate's all screwy. We gotta deal with that. Doesn't really have a very good average base upon which to create an average. So we're just gonna play with this. Times 2, turn it into 12%. This is the thing about that. I mean, look. See, paying your taxes helps. Okay. The reason why is because you can take interest expenses deferred off your taxes. So by having a decent amount of debt weight and then also paying your taxes, you can actually end up in a good position. We're actually going to assume the 12% because they probably have a lot of deferred tax rollover. So, and as I said, it helps. So we're actually being conservative by assuming a lower tax rate for the next 5 years, sort of. Rolling debt is a little higher than their actual number. I'm comfortable with that. This is where things get a little bit tricky. Sort of have to ignore these things here, but expected sales capital is not very high, but they're not in like normal biotech, they're in biosimilar tech, so it's actually gonna be a little bit higher. I don't really have a biosimilar industry group category to compare with. Still. Okay. Arguable that I could put this up at 30 to make a difference. don't think that's really an assumption. This won't work, right? Yeah. I really need to fix whatever problem I have in there that's like screwing with the distribution and making that happen. Should be able to put in a 0 just fine, but it won't do it. I want to do it. This is the $2 per share. That much. Or 50 per share, really. I think this is a pretty good set of assumptions. Like, basically assuming that they, you know, go bankrupt under those circumstances, but are very profitable under other circumstances. Like I said, I kind of kept this lower than it could be because you could, based off of their adjustable markets they're trying to target, you could perhaps suggest this to be even higher, and then it's possible. I guess theoretically you could say that goes to 0, but it's like I don't know. That doesn't change that much. Oh man, I have that 0 the entire time here, didn't I? Okay. So it's actually probably even more better off. Let's put 5%. Okay, well, not too much more. I only added like 1 more %, but I mean, that makes a big interesting. Maybe that's a little much to assume, I don't know. Or maybe if I should do that, I should be a little assumptive that they'll be better on that front. Yeah, because I don't know. I do want to leave in the possibilities for them to go bankrupt, I guess, but maybe I'm just being a little rough on their potentiality for them as far as middle cases go. And I also did kind of pre-weight a little bit further this way. Maybe I shouldn't have done that. Maybe I should have just left it similar, because I really don't have that much of a distinction on it. So just leave it at my kind of default distribution, I guess. I was kind of quick to punch them, maybe unfairly. If I'm going to punch them so heavily in the potential margin fallout, then it's not necessarily fair to punish them in other categories. Still ain't got to the faults. Alright, I do think I'm pretty pleased with this, I think. Definitely a wide band of possibilities here, but narrowing it any further, I think, is too presumptive. Just for the defaults, though. Okay. All right, I do think that's pretty much it. And pre-plan to have it ported over to the watch list immediately, so we're not really. I'll have to look at that next time because I kind of want to get off here soon. But this is pretty much what we came up with. Like I said, we stuck with our pretty default standard evenly set up distribution. I tried not to make too many bold assumptions there. We did assume that they have a pretty strong potential sales downside because of the high volatility in their potentials. Although, like I said, I do think their biosimilar business is really going to be a little bit more of a steady eddy. So I don't really think that that's actually the case, which is why I give them a little bit more of a standard growing sales rate overall. The potentiality that they actually shoot up to their possible projected addressable markets. I'm assuming that the analysts are a little bit less optimistic than me. Like I said, but it's a pretty wide band, and you get 15 to 30. It kind of distributes at a positive 7% per year, which is pretty strong growth, but not crazy growth, right? And then sales capital, I'm assuming that does improve pretty significantly. That's definitely a huge part of where their strength comes from. Maybe it's a little presumptive, I don't know. Push it down slightly. I was just thinking that wasn't going to affect any of this too much. Okay, it didn't look like it affected it too much, so it's so good. All right, I put it down a little bit. But either way, the sales capital is going to push up. That's partially because this number is looking at the average, which is missing out in the most recent years. So we're assuming that they're going to be somewhere in between this spacing, essentially. And then in terms of invested capital, they're actually going to stay relatively the same, we're assuming. That's equity they're probably going to increase, but maybe they won't. That'll be better for them. Default risk is a little bit higher than the standard level, partially because of the potential on the worst cases. And then profit margins, we're assuming that they improve slightly, but mostly just kind of maintain the average of the last 2 years. And then profit will improve overall. On distributed level, it seems like it's a negative downside, but that's just because of the high band of potentiality for it to go south, but it could also improve rather drastically. The band of valuation is also pretty chaotic, anywhere from dropping like 85, 90, 95% to perhaps 3.5 timesing. It's not really super appealing, honestly. Like, it's like I said, I kind of would like this as a backstop against another holding, but I don't know. I feel like I'd want it lower than that, maybe around 12, maybe even lower, closer to 10 perhaps would even be better. Well, the short-term regression upside suggests it's pretty good too, and the returns I'm suggesting are pretty decent too. 5-year forward does improve the scenario where it becomes more of a 70% downside to a potential what is that, 7x. That's a little bit better, which definitely makes it feel like it's a better potentiality. That makes it more appealing. I don't know. Maybe not down to 12. Maybe I'll take off small nibbles of it. I'm not sure. Like I said, like I always say, that's definitely not a recommendation for anybody else per se. And because besides, like I said, I'm pairing this off with an AbbVie position, and I also built my AbbVie position a long time ago. So it's not like you should just run out and buy both AbbVie and Coherus and think that you're doing the same thing as me. I might even be buying more AbbVie, but again, my average cost basis is significantly lower than the current price. So, well, that's definitely Coherus Bioscience. Very interesting potentials. Like I said, it definitely has lots of risks, but it has lots of potential to it as well. Perhaps picking it up on bad days is the way to go. Just try to make sure you're getting it in those down markets. But at the same time, like their overall pipeline is gonna keep moving, and if you don't have a position built by the end of 2021, well, then a lot of the stuff that's supposed to be determining their overall long-term potential is supposed to be happening in the first half and the second half of 2022. So it's like the time to hop into this one is basically right now. You could say it's like a bit of a call option on the biosimilar space as that starts to develop with some of the largest drugs that are potential biosimilar candidates go off their patents in the near future. You know, Revica, adalimumab, and Humira especially. So, this has been Live Valuation. If you liked the stream, please like the video. Please subscribe to the channel. Do all the streamer stuff. Share with friends. Make sure the notification box is clicked. Yada, yada, yada. We stream Monday, Wednesdays, and Fridays at 10:30 a.m. Eastern Time. I'm not sure which one we're going to be doing on Friday. I'll make that decision in the near future, but if you show up early enough, you can perhaps convince me to do a different company. But all right, I'll catch you all